everybody's afraid of mortgages. Everybody's afraid of finances because they don't want to seem like they're ignorant to it. Mm-hmm. Nobody wants to seem stupid or ask a difficult question.
Right.
Because nobody teaches them.
Jen Rossides is a seasoned mortgage broker with 20 years of experience following a successful career in banking. Known for her expertise in construction mortgages and purchase plus improvement loans, Jen has helped countless clients navigate the financial complexities of building or renovating their dream homes.
The thing that's going to affect your credit the most is if you are at the limit or above the limit. If you're above the limit, you're screwed. And if you are missing payments, you're in a lot of trouble.
In this episode, Jen shares invaluable advice for listeners tackling home construction projects, from understanding financing options to managing budgets effectively. Whether you're planning a major renovation or building from the ground up, this conversation is packed with practical tips to help you manage your money wisely and make your vision a reality.
Don't start, furnishing your home. I don't care what you do after you close that house, but before you close that house, stay away from any new credit.
Hi everyone, I am so excited to announce that my podcast is now officially sponsored by Baumler Approved. Over the past year, I've had a privilege of being able to work with Brian Baumler and his team, shining a light on the amazing tradespeople in the trades community. And now, with their support, we are going to take things to the next level. We are inviting Ottawa tradespeople, tilers, framers, electricians, you name it, to join us on the podcast. If you're passionate about your work and you want to share your story, talk about the highs and lows of running your business, we want to hear from you. And especially if you have tips for homeowners. So stay tuned. There's so much more coming. But if you want to be on the podcast and you're a tradie here in Ottawa, reach out. We definitely want to hear from you.
We have hundreds of contractors that love what they do. They're skilled. We've done the background checks. These are companies that share a mindset with us, that are out there to take care of people. This is a service for homeowners, to just give you that green flag.
Welcome, Jen.
Thank you for having me.
A little different of a podcast today with you because you're not in the construction world, so to speak. You don't wear work boots.
No, I don't. I'd like to.
Oh, yeah? I can arrange that. But you're here today to talk to us about money. Something that is can be contentious, I guess, when it comes to renovations. You need to have it in order to renovate. But you're a mortgage broker.
I am. I've been a mortgage broker for about 20 years now, and I was in the banking world previous to that for about 12 years. Mm-hmm. So I've done just about every job there is with banking, but love mortgages.
Love mortgages. Yeah, you've been doing a mortgage. I mean, you've done my mortgage. I've known you for a long time, right? So we've been able to work together over the years. Why I wanted to have you on the show, though, was to talk a little bit about construction mortgages. We talked yesterday when we were kind of talking about it, but we build and finance, I guess, right? What's that called?
Construction mortgage?
Yeah.
The purchase plus improvements.
Purchase plus improvements, yes. So that's common that people would do that. You also, if you want to build a new house, you can... you're going to need a mortgage to do that, right? So let's talk about what it is when someone comes to you right away and says, "Hey, Jen, I want to build a house."
First thing is clients have to really have a budget. They have to know exactly what it's going to cost from the city, what their plans are going to be. They have to know how much the land is going to cost, everything. So what we do is we sit down with them and give them parameters on what they're going to need. Most people are going to have paid off the land. If they haven't paid off the land, then they're going to have to put at least 10 to 15% down on the land in order to finance the build.
All right. So someone comes to you and says, we'll use my son as an example. My son's dream is to build a house, and he's saving up to do that. So he's going to come to you and say, "Jen, I want to build a house." The easiest way to do that is for him to already own the land or have the land financed.
Most people, it's the city of Ottawa, right? If you want a 1 acre lot, you're looking minimum $250 for a plot of land, right. $300,000. So chances are they're going to have to get a mortgage on that land. Okay. There's different ways to do it. We can do it through some of the banks. We can do 65% of the value. So they have to have 35% down
on the land.
Or we can do it privately as well, and then we can have higher amounts that are owed. But you really have to start paying it down.
Right. Okay. So he has this land, he has a mortgage on the land, and now he wants to build. So I think what I'm trying to get at is he going to be engaging with a general contractor first and get these plans done, or should he be engaging with you first to find out how much the budget should be for this build?
They really need to understand how much they can afford, and then they have to have cash on hand. So it's kind of, they have to do both at the same time, because they have to know what they're looking at for costs, what kind of house they're looking at, but they need to know how much they can qualify for first.
Okay. So the qualifications, let's dig into that. So for argument's sake, let's say my son and his wife make, I don't know, $150,000 a year. So, and I know you had a calculator and we took it away, but what is it that you're looking at to qualify for this build?
You're going to have to be able to finance the mortgage itself. So $150,000.
Tight.
It's going to be tight. $500,000, maybe you're going to be able to qualify for, assuming you have no other debt.
Right.
Because you have to qualify at the rate that you're going to get. Let's say the 5-year rate at 4.44%,
right,
plus 2% for the stress test.
Let's talk about a stress test.
Yeah.
What is the stress test?
The bane of my existence.
Okay.
The stress test is something that was put on in 2016 when the government changed a lot of the mortgage rules. And what it is clients have to qualify for 2% higher than they're actually paying at a 25-year amortization. It's hard. And in these last few years, with interest rates being as high as they have, it has been really hard for people
to qualify. So, and when you're qualifying, what's the basic math that you look at? Like, what does qualified mean?
Okay, so qualifying means there's two ratios that we use. One is called gross debt service ratio, which is your principal, interest, property taxes, and your heat. So we include that, and that cannot exceed 39% in most cases of your total income.
Total before tax or?
Yeah, before taxes.
Before tax, okay.
And then your total debt service ratio is your principal, interest, taxes, heat, plus any other debt you have, like cars. Cars are huge. Credit cards, anything like that. And that cannot exceed 44%.
So one of the things, okay, because you said credit card. I know cars are huge, and we'll talk about that, but credit cards. When we're talking about figuring out these ratios and someone wants to buy a house, build a house, what have you, the bank normally assumes that credit card for qualifications is full, even if it isn't, or is there some leave room there?
What they do is they take 3% of the balance owing.
Okay.
So that's how they qualify. And which is, some institutions, you only have to pay interest only on those credit cards, but the bank will use 3% of what's owing.
That's owing on the credit card to make, yeah. So 39% and 44%, they're not
huge.
They're not huge. They're very small numbers. And with an interest rate of 5%, and then your stress test would be 7%?
Correct.
So basically what it is, you're taking the monthly mortgage payment, you're adding it to your already debt load, and you're hoping that it doesn't exceed 39 or 44% of your total income.
Exactly.
Yeah, that doesn't leave a lot of room.
It doesn't leave a lot of room for qualifying purposes, especially when you're looking at the average price of houses. And if you're looking at the average cost of build right now, you must be over $500 a square foot.
Yeah. So the stress test was put in 2016. It's been around for a while.
Correct.
There's a lot going on right now in the finance world with let's say the impending change of government that we're going to have here in Canada. I think there's no doubt that we're definitely going to be headed for an election. Do you think that the stress test will change? Do you think that's something that the federal government will look at?
Yes, I do. The Mortgage Brokers Association of Canada has been lobbying for that for quite a long time. It's not going to go away completely.
Okay.
But I do think that we might have it like at 1% instead of 2%, which would be a lot better and make a lot more sense.
Right. Yeah. Yeah. And what about young people when it comes to the down payment?
So down payment, again, is a hard thing, right? When you're looking at the average house in Ottawa, it's over $500,000 now, I think. Single family homes are around $700,000 in Ottawa. So the average price is 5% of the first $500,000 and then 10% thereafter. So for every dollar after $500,000, then it's 10%. So that's quite a chunk of change for people. So, you're coming out for down payment. So if you're coming out of school, buying a single family home is usually you're not able to do it.
No.
So parents are helping a lot. And in Ottawa, we are so fortunate, like we discussed before, we're kind of in a little bubble because we have so many federal government employees. They have the income where they're able to do that.
Right.
The rest of Canada doesn't have that, where they have pensions or they have stable jobs like that.
Right. Yeah. Yeah. Certainly, down payments can add up
Yeah.
to a lot. And that's what my son has been saving up to do, right? He's young. What about credit rating?
Credit rating is really important. The banks heavily rely on a person's credit rating in order to get you the best rate possible.
Mm-hmm.
So you're looking at, you have to have a minimum of 680 in order to get, a CMHC or Sage and Improved mortgage that's 5% down,
Right.
or less than 20% down.
Mm-hmm.
And just making sure that the payments are made on time. So I suggest that everybody have automatic payments come out of their bank account to make the minimum payment. I suggest that the other thing is you have to have about 3/4 of your limit. You can't go above that. And really you shouldn't. You should try really hard not to, because it's just a trap.
Right. Like credit cards, you mean?
Credit cards are a
Line of
trap.
credit, whatever.
Yeah. And cars are the worst, because people are walking out of dealerships and getting $1,200 a month payments on a car. But I can't get you a mortgage for that.
Right.
So that's a huge discrepancy in the marketplace.
Buying a new car with a $1,200 payment will affect a lot when it comes to your credit rating when you're going to try to get a mortgage, or your qualifications like credit
Absolutely.
rating. Yeah. And it can basically turn it upside down. And I've heard horror stories, and you've told me horror stories about people getting qualified for a mortgage.
Oh gosh, yes.
Yeah, and they go house shopping, and the week before the house closes, they decide, well, they also need a new truck.
Yeah.
And then on closing day, they pull that credit, and now those ratios don't make sense.
Yeah, and that is something that we warn our clients. Don't go to the brick. Don't start, furnishing your home. I don't care what you do after you close that house, but before you close that house, stay away from any new credit.
Mm-hmm.
Yeah, don't get a new car. Don't change your job. Don't go on vacation. Seriously.
Just sit and wait.
Yeah.
Just go buy a house and wait for the closing.
Wait. Do
Wait
nothing. Plan for the future, but do nothing in between.
Okay. So let's go back to, my son, we're using him as an example. He wants to build a house. He's went out and bought the land, and he's qualified to build something for $500,000, let's say. How is he going to be interacting with contractors, and how are those contractors going to get paid for that work? Like, the bank's not going to cut him $500,000 and be like, let me know when it's built.
Yeah. So we do draw mortgages. So what's going to happen is Cameron's going to go in, he's going to do the application for credit. We're going to figure out exactly how much he can afford to do that with. We have to have a buffer for him as well, because when you're doing a construction mortgage, it's based on draws, and typically there are 3 to 4 draws, and the first draw is at 30%. So a person has to have enough available credit to get to the first draw, and that is fully enclosed. You have to have the roof on, windows on, and door kind of thing.
Okay.
So that's your first draw.
But not siding.
Not siding, no.
Just a structure
enclosed.
Yeah. Okay. And so Cameron would be financing the first 30% of the build.
Yeah.
Okay.
That's where if you've had the land paid off, the bank can draw from the equity in the land for some of that.
Okay.
But people really have to understand they need minimum $100,000 kind of thing lying around in credit or available to them so they can get to certain points.
Right. Because at this point, it's still not a mortgage, so to speak. There's no asset really there for the bank.
No, the bank will put a mortgage on the land. So the bank will start that whole process. But again, they're not going to give you the money right away.
So the contractor, when it comes to getting paid, has to be able to understand those milestones as well. Then understand that the money may not be there until. But I mean, that's really hard. We have ironically, we have a concrete guy coming in, right? So the concrete guy, he's coming on the show in the next few hours. But he's going to go pour my son's foundation. He's going to want to get paid long before the windows go in and the structure goes up. So that's where that cash that Cameron has is going to be able to pay that. Yeah,
they usually have like N30 though, N45, N90 contracts with people where they don't have to pay right away. But again, it all depends. If you've got if you're doing it with a little builder, or you're doing the construction, you're the general contractor, then you got to pay that guy right away. But if you're dealing with a well-known contractor, then they've already got the terms set up.
Right. Okay. So then windows go in, there's a structure, there's a roof. What's the next draw?
So the next draw is so that's like 30%. So the next draw is about 45%. So you'll have the electrical stuff in, some of the plumbing stuff in,
Right.
all that kind of stuff.
Okay.
And then they'll have another draw at 60, and then the last draw is at 98% complete. So when the house is 98% complete, that's when you get your final inspection, your mortgage, and then it's all
So
done.
you have your occupancy permit. But who's making these decisions? Like
Inspectors. So each time there's a draw, we have to have an appraiser go in and give you, appraiser goes in and then says, yes, this much has been done.
Right. So an appraiser would be different than a home inspector.
100%. Yeah.
Yeah. So it's just, okay. So the bank is just trying to protect their interests. Is what
Absolutely.
they're trying to do, right?
Yeah. Because, like if you look in let's take the 70s, because I'm old, take the 70s, for instance, you would have those houses that would have the black stuff all around it, right?
Yes.
And you never actually have it finished.
Right.
Well, they want to avoid that.
Right.
So they're not going to give you all the money until the house is 98% complete.
So when it's 98% complete, and now my son would like to have a normal mortgage.
And that is a normal mortgage at that time.
Yeah. So, okay. So now it's converted to just a normal mortgage. Yeah. Okay.
And because he's a first-time home buyer, after December 15th, he would be able to get a 30-year amortization, which is a great thing that the government's actually brought in for first-time home buyers.
Okay. So now, let's dig into the mortgages. So what are some things that a young person can do to help get credit? Like we have these graduates, let's say from Algonquin or university or wherever, from college, university, they maybe don't have great credit because maybe they haven't used credit.
Yeah. So what they need to do is they need to go to their bank and you need to get 2 credit cards with a minimum of $1,500 limit each, get them up to $5,000 each and stop at that.
So you start out with a $1,500 credit, you use it and you always pay it off, like you said before, and then you get it to a $5,000 limit.
And then just kind of keep it there. Just try not to get into that whole credit cycle because it's never the mortgage that'll kill you. It's never your house that's going to kill you. It's all your credit. That is what is going to kill you.
Right. So then that would increase their credit
And don't
score.
buy a big car. Don't buy a big truck. Buy something used. Buy something that's economical for you.
Right. Yeah.
Don't get in the trap.
The trap that is so easy that you've mentioned a couple of times now, it's because credit is lent differently, and we touched on it before, right? Credit is lent differently for houses than it is for cars and for credit cards and stuff like that. But the reality of it is, if you're 20 years old and you don't have a credit card,
it's easy.
It's easy, but you do need it.
You absolutely do, and I totally get that. And I love cars, but it is a trap because now you can't afford to buy that house. And like I said before, a car is a depreciating asset. A house is an appreciating asset, but the government's made it so difficult for somebody to get a mortgage, which is a place for you to live, a place for your family, a place for you to grow, a place for you to have wealth.
Right.
It's really hard, but a car you can get like that. Interest rates are really high. People are paying 8.99%. And the average vehicle, like a Toyota RAV4, I have one, right? $50,000.
Yeah. Have you heard of, I don't want to say the name. There's a certain truck that drives around and you can go buy tools on credit.
Oh, yes.
Right? That is the same as a credit card.
Yes, it is.
And it will impact the same thing.
Yep.
What does a missed payment do to your credit score?
Oh, it brings it down significantly. And this is the thing, right? Like the thing that's going to affect your credit the most is if you are at the limit or above the limit. If you're above the limit, you're screwed. And if you are missing payments, you're in a lot of trouble because it takes one missed payment is going to take you about 8 months to a year to fix. If you miss 2 payments, you're looking easily a year for that to be
like on
recovered.
A credit card?
On a credit card, a loan, whatever.
Right.
If you miss any payments on your mortgage, forget it.
Forget it. Yeah, it's a problem.
Huge problem.
Okay, let's dig into purchase plus improvements.
Yeah.
Because I know I play around in that field a lot in my renovation company. I know people purchase their homes and want me to renovate it immediately. I will tell you, I normally decline. There's 2 types of clients that I will decline in my renovation business. I just bought my house and I'm not moving. I haven't moved in there yet and I want to renovate it. The reason why I decline it is not because of money. I know that they have the money. It's because of where they are at their life.
Agreed.
They haven't lived in this house.
Exactly.
And they have what typically happens is they have their apartment to end out their lease and they have this hard out and they want to do all of this work and they give me a month or 2 months to do it. And it's just not worth it. Like it's just so stressful for my team that we normally decline. The other people that we decline are people who are they don't have the ownership yet. So
Right.
the house is not closed. So I get a call from a real estate agent that says, hey, these clients have bought this house. It hasn't closed yet. Can you come? We want to renovate the bathroom, the kitchen, this, that, and the other thing, right? But contracting aside, let's talk about how people get these purchase plus improvements. And is it the same regulation when it comes to how they qualify? And is it the same type of draw thing that they have to do to get access to the money? How does that work?
It is the same. They qualify the same way. So you qualify for a higher amount. So what will happen is you're going to go in, you're going to make an offer on your house.
Mm-hmm.
You're a real estate, you're going to see, okay, I want to do this, I want to do that. Before you sign off on your financing for the house and you want to do the renovations, you have to have your contractors go in. They have to give you estimates as to what the costs are going to be, what you're going to do.
Right.
Then we have to take that, send it to the bank, and the bank has to say yes or no.
Right.
Because if it's something that's not going to add value, the bank doesn't want it, obviously. But if you're going to do a kitchen, you're going to do a bathroom, it's going to add huge value to the house. So yes, the bank will approve it. Some of the banks have stipulations as to how much money on a percentage basis they'll lend you. We do have a couple of different lenders who will lend a little bit higher than the norm. So $100,000 for one of those renovations.
Okay.
Again, it all depends on the value of the house. Everything's mixed into it, right? It's not a simple thing. And then what we'll do, typically, the client has to fund most of the renovation on their own. Okay, if it's a $40,000 one, they have to fund the renovation on their own.
Okay.
And then the bank will pay them back for that money because it'll sit in the trust account from the lawyers. Once the renovation has been completed. Again, an appraiser is going to go in and say, yes, this was done, this was done. If for any reason, some of the things that they have specified that they were going to do have not been done, they're not going to get that money.
Right.
So if you switched it up, so I had one client one year who decided, well, I was going to get windows, but then she decided, no, I want to get carpets and flooring. Didn't tell us. And the bank is like, carpets aren't going to add the value the windows are going to go to. So now she was out that money.
Wow. But she could still do the windows.
She didn't have the money to do the windows anymore because now she spent it all on the flooring.
Oh, okay. Yeah, right. She has to front load it.
Right.
Right. Wow. So it's regulated.
It's all value, right? Every time the bank does something, they're going to see like what value is it in for them, and then what risk are they taking.
Right. So
it's a great way to finance stuff, though, because it's the cheapest way to finance things. Because you're going to be getting that mortgage interest rate. You're not doing a refinance or anything like that. It is the best way to do it. Mm-hmm. But I understand the stipulations from a contractor's point of view. It's hard.
Yeah, from my point of view, it's like, well, you don't own this house. And I know you're just getting quotes for this reason. And I know that you're going to have a very, very tight deadline. Why would I want to do that bathroom for you when I could go do, another bathroom with no deadline?
As for the purchase plus improvements, you can do it for 6 months.
Right.
So it doesn't have to be done in a month. But I understand how they're pushing for it to be done like that.
This is a client thing. They want to move in the house, right? They're renting. I get it. Yeah. They're renting, right?
Because I hate the dust.
Everyone hates dust. I mean, I'm in the dust business. I said it a million times. The other issue is, and this is the biggest issue that I talk about all the time when I'm talking at home shows or whatever, is if you haven't lived in the home.
Oh yeah.
You don't know what you want. And then they go and they get these designs, they hand it to me, and halfway through they're like, hey Ryan, I want to change it. Well, change fees start at $250. You know what I mean? So they're blowing through this money, making change requests, and it's stressful on my team. And because what happens is, from a contractor's point of view, you make a change request, we have to maybe get different tiles, or we have to do that. It impacts the schedule, which impacts all of my schedules, right? So it's hard. And I always say to people, live in the home for a little bit. Let's decide where you want the kitchen island. Think about this space.
Oh, I agree completely.
Because what happens is it's so rushed. And then you end up we'll build you a beautiful kitchen, but you're going to end up paying more than you have to because you are going to be indecisive. So let's talk a little more about mortgages. Let's talk specifically about misconceptions that people have about mortgage brokers, about going to the banks, the posted rate, a discounted rate, a rate that can be bought down. There's so much stuff that we can do when it comes to mortgages. What do you think when people come to you and they say, hey, Jen, I want a mortgage? What do you think their biggest, what education piece are you giving them the most? What are they misunderstanding?
It's hard because everybody's afraid of mortgages. Everybody's afraid of finances because they don't want to seem like they're ignorant to it.
Mm-hmm.
Nobody wants to seem stupid or ask a difficult question.
Right.
Because nobody teaches them. So I just kind of start from the basics with people. Like, do you know what a mortgage is and how it works? And just kind of take it from there.
Yeah. Like the you mentioned the GDS and the TDS. I bet you a lot of our audience just kind of went, what now?
Yeah.
You know?
And you know what? In all honesty, when you start talking numbers, people get stressed and they will actually block it. No, I'm not. It's just genuine, right? Like people will block certain things because it does stress them out because nobody wants to deal with money. Like nobody wants to deal with having debt.
Yeah, it seems to be
it's stressful.
A level of success that people say, oh, well, I don't have debt, or I have, they want to make it seem that they have more than they have. But we all go through this getting a mortgage.
Yeah.
What about so you're a mortgage broker. What's the difference between going through your company and going through a bank?
Mortgage brokers, this is all we do. We are professionals in our field, just like a stockbroker, just like an insurance broker. We specialize in what we do. So I have access to 50 different lenders, whether
including
it
the
be,
banks.
Absolutely. Like whether it be the, Scotia Banks, TDs, Bank of Montreal's of the world, to the mono lenders who are, I'm going to say First National, for instance. Mono lenders are lenders that only deal in mortgages, and they are phenomenal at customer service, great rates.
Yes.
We also deal with alternate lenders. So if you're self-employed, a lot of self-employed people have to go alternate because our income may be a little bit skewed. Mm-hmm. Anybody who's had some credit issues, divorces, all that kind of stuff, to private mortgages, like we can do just about anything. Mm-hmm. When you're going into the banks, and I can say this because I was a banker. I was 22 years old, just out of school. I had 1 day training from Scotiabank, and I was dropped into Streetsville as a mortgage person. I knew nothing. I was 22 years old. What did I know?
Right.
And unfortunately, the banks are still doing that. That is still how they're training people. Yeah. And that was 30 years ago. So, mortgage brokers offer a lot more. We offer experience and we offer services to clients that they just don't have because we have so many different mortgages to choose from. Mm-hmm. Not everybody will go into one box. Right. And the banks, they're really good people. I'm not knocking the people who are working in the banks. But the institutions will only allow them to sell that product. So the people who are working there only know those products.
Right. Yeah. If you work at...
So if you don't fit into the box, then goodbye.
Mm-hmm. Mm-hmm. Yeah. So you have more flexibility.
Absolutely.
This was super educational. Thank you for being on
the
show. We're going to put your information up on the screen for people in Ottawa who want to talk to you about their mortgages, new contractors who are thinking about leaving the nest of the company and starting their own company. They need to have conversations with you. Thank you for being here. It was great.
Thank you.